The time to get ready is now, folks. Welcome back to the channel. It's Ron here. Hope you guys are doing very, very well. We have a lot to cover in today's video, but I want to keep it as brief and concise as possible. So the banks are making some big changes. All of the banks, large banks, small banks, JP Morgan Chase, Bank of America, Wells Fargo, your regional banks, your small banks, Citibank, you name it, right? Fed's raising interest rates, and the Fed is still battling inflation. But what they don't tell you is that they want you to sell out of your assets. They are literally setting the average American up to be stuck on the rat race, on the rat wheel, and to not participate in one of the greatest wealth transfers that we've ever known. You see, guys, I don't know where you happen to live in the United States, maybe outside the United States, but I'm still seeing construction going up. Companies are still building commercial buildings, real estate, commercial buildings, residential, multifamily real estate, luxury apartment buildings. Let me know what you guys are seeing. By the way, if you guys are stopping by the channel for the first time, please consider subscribing to the channel. And while you guys are at it, go ahead and smash that like button. I really, really would appreciate that. But the simple fact of the matter is that what we're experiencing right now is a lot different than 2008. It's a lot different. There's a lot of different variables. And first, one of the biggest variables that's just glaring is the fact that the average equity in the United States, the average homeowner who owns their home, and when I say the average, this doesn't mean everyone. Technically, this is like more or less the median. The median equity in the United States is $200,000, meaning the average person, the median homeowner, owns a property that has appreciated by $200,000 over their purchase price, or the property is worth $200,000 more than what they owe. So there's a significant amount of equity in the properties, and this was not the case back in 2008. I don't care what they're telling people nowadays, right? Credit scores. If you go to Experian, TransUnion, Equifax, you will find that the average credit score for those who have been approved for mortgages on average is significantly higher than the average credit score was back in 2008, meaning that the average home buyer that bought a house in the last 3 years, heck, even the last 5, 6, maybe even 10 years, since the whole 2008 credit crisis, they have changed up the lending standards dramatically. I'm not saying that there's no crap loans still out there. There's some loans that are just, not necessarily for the highest quality buyer, but the average, if you look at the averages, the average home buyer was way more qualified to purchase a home in the last 10 years compared to back in, 2006, 2005, 2006, 2007, and 2008. Okay? Big difference. Why does this matter? Well, if the buyer is way more qualified, then chances are they're not going to default on their loans, and there won't be a foreclosure. There won't be a short sale situation, or at least the chances of that happening are drastically reduced. It doesn't mean that foreclosure and short sales are impossible, but if your buyer is way more qualified, then the likelihood that that happens is reduced. So if you're not forced to sell out of your house, then why would you take a loss? And again, most people aren't going to take a loss because they got, on average, about $200,000 in equity. So they ain't losing no money. Now, there may have been a slowdown in sales in the housing market. I mean, you can look at Realtor.com, Zillow reports come out all the time. Redfin reports come out all the time indicating that home sales have slowed down, though they have picked up in 2023. They're not as robust as they were in 2022, 2021, but those are anomalies. So the other thing you have to take into consideration is that the number of adjustable rate mortgages back in 2008 was insane. And that was, it's very interesting how history repeats itself, right? So the Fed has raised interest rates I lost count how many times, but they started raising interest rates March of 2022, and they've done it a number of times since then, very aggressively. And the last rate hike was like 25 basis points, but we're under the impression that this might be the last one. Maybe there might be a couple more, possibly even a Fed pivot and start cutting rates. I think that's very unlikely to see anytime soon, especially with unemployment still as strong as it is. Me personally, I just don't see that the Fed is under pressure to have to reduce or cut interest rates at this time. However, 2008 was an anomaly. And I think what's really interesting is that, so many people are comparing 2023 to 2008. As a real estate investor, it's like, if you look at the history of real estate, and I looked at it going back like 100 years because I was curious myself. I went on like the Federal Reserve's website. They have like tons of great resources on there. Most people won't ever even visit that website because it's kind of boring and it's not very easy to navigate. But anyway, I found some really good reports, some great charts, and 2008 was clearly an anomaly. And it's funny, like as a real estate investor, a lot of investors are using 2008 as their basis for whether or not they should invest in real estate today or buy a house or sell their house today. And I just don't think that's necessarily the smartest thing to do. Why would I want to base my real estate investing, home ownership decisions based on an anomaly situation rather than looking at many situations to see how real estate has performed historically? Like, you got periods of time like, okay, today, 2023, you got 2008, but what about 2001? What about 1991? What about the 80s? Like, there was a time where interest rates had hit like 18%. Did real estate prices crash like they did in 2008? Well, they pulled back maybe 7 to 10% when they ran up to like 18%, if I'm not mistaken. But they ended up rallying. The price of real estate ended up rallying forward within 12 months. So there was like a brief pullback. Whoever was waiting on the sideline, who happened to see the opportunity, kind of swooped in and got some real estate at 7 to 10% of a discount. But within 12 months, the real estate values had recovered. And so I don't know. I just don't see that the current 2008 situation is anywhere near what we saw back in. I don't think that our situation today in 2023 is anywhere near what it was in 2008. That was way more of a crisis. What is interesting, though, and I always say how history has a tendency to repeat itself, is that back in 2008, I'm not going to say everybody, you saw all sorts of really aggressive loans, wild loans. Basically, if you got a pulse, you can get approved for a mortgage, which is just crazy. You have people with interest-only loans, no doc loans, no income verification, no down payment. You had adjustable rate mortgages. Well, what happened that really helped to crash the market was that the Federal Reserve began adjusting interest rates. And as these interest rates adjusted, mortgage payments started going up. Everybody started getting letters from their bank basically telling them, hey, mortgage payments going up. And I wouldn't be surprised if their property taxes affected the cost of their mortgage payment, their homeowner's insurance. But then they got slapped in the face with the fact that the Fed was raising interest rates, and then their principal and interest payment on their mortgage went up. Because your payment's broken down into principal, interest, taxes, and insurance. Now, of course, if you got an interest-only loan, there was no principal. It's just interest, taxes, and insurance. But anyway, that you don't really see many of those interest-only loans today. To my point, buyers are a lot more qualified today. And another thing that's really showing how history has repeated itself. It was the interest rates being raised by the Federal Reserve back in 2008 that initiated the rising mortgage payments, which led to people not being able to afford these payments that they were barely able to even qualify for to begin with. And then once they started getting behind by several months, foreclosure proceedings began. And that pretty much started the wave of foreclosures and the crash of the housing market, since so many foreclosures started hitting the market at one time. And the amount of foreclosures hitting the market was dramatically more than the demand to buy real estate at the time. So what happens when there's way too much supply compared to the amount of demand? Well, we've seen this already so many times. The prices drop, right? When gas prices started falling, it was mainly because there was such an excess of oil and gas inventories. And the same thing happens with any healthy economy. If there is an excess of supply and the demand can't meet the excess, well, generally speaking, prices will start to decline. Again, we're not seeing that today. There's still, because a lot of people have great interest rates right now, locked in. I mean, I got a couple properties right now under 3%, 30-year fixed rate mortgages. I'm not trying to refinance. I'm not trying to sell these properties. Why? Government gave me free money. The Federal Reserve has made it very easy for people to become rich. And a lot of people are getting rich, regardless of what they're telling us, right? $200,000, what the average or the median homeowner has in equity in their properties. It's pretty substantial. So it's like Americans who did not own assets during one of the greatest asset bubble collection of asset bubbles, I should say, in American history, they really got left behind. And I feel bad for lower income Americans who had a dream of home ownership. Like, the idea of being able to own your own property, you know, that's something that I feel that a lot of people take pride in. And beyond the pride, you know, there's an emotional benefit to that. It's also something that you can hand down to your kids. And it's also something that has, and for the foreseeable future, will continue to appreciate and go up in value. Real estate is that asset that is it's rather diversified, in terms of what it can do. You know, you can live in it, you can touch it. Compared to a stock, it's like, okay, I can log into my M1 Finance account, my E-Trade or, Vanguard account, and look at my stock holdings and my ETFs and index funds, but I can't do anything with it, Now, granted, those things generally, if you make good investments and did your homework, they'll go up in value, maybe pay some dividends and passive income and things like that. But you don't get the depreciational tax benefits that you would get from real estate in stocks. You don't get that. The less you pay in taxes, the more you keep in your pocket, the more you keep in your bank account. All right. Also, can you change the companies that you've purchased stocks in to make them perform better? Not really. Best thing you can do is probably write a letter to the CEO and be like, yo, man, I've been to your Bed Bath and Beyond stores, and I think you need to make some changes. But chances are the CEO is not going to, respond to you, number one, or even receive or read your email. But if you own real estate, commercial or residential, you can make improvements to the property. You can make changes to the property to make it perform better. I've worked with, I haven't done this myself, but I know enough real estate investors. I'm a real estate investor myself, but I just haven't done this scenario that I'm going to talk to you guys about. But I've worked with other real estate investors that they'll buy these properties, negotiate the price down, get a great deal on the property. They will finance the property through either a hard money lender or whatever the case is, wherever they get the money from. And ultimately rehab the property, improve the curb appeal to the property outside the house, renovate the property to make it very, very nice for a very competitive price. convert an office into a bedroom, and then take a 3-bedroom house, make it a 4-bedroom house by simply adding a closet to it. And all of a sudden, they've increased the intrinsic value of this property by making some improvements to it. This increases the value of the property. But in addition to that, it also increases the amount of rent that can be collected. And I'm talking about from a long-term renter standpoint, as well as if you happen to list your property on websites like Airbnb or VRBO and vacationrentals.com and stuff like that for short-term rentals. These are things that you really can't do with stocks. Now, I'm not trying to crap on stocks because I'm a huge proponent of investing in the stock market for the long term. But there are different types of asset classes, and we need to understand the differences between them. And we also need to not get scared and get shaken out of good investments just because the market moves or some news comes out, right? Like, we have to understand the investments that we're making deep enough. We have to have a deep enough understanding of the investments that we're making so that when there's a little bit of turbulence in the market, if some, headlines come out, we don't get shaken out of good investments. That's what I'm saying, right? And I think that, the powers that be don't want more people to become wealthy. Why? Because some of these powers that be take advantage of people who don't know better. That's just my take on that, So, I think that there's like trillions of reasons why 2023 is not the same as 2008. There's also like drastic changes in the underwriting restrictions that were imposed by the Federal Reserve, which is why we're not going to have a 2008 sequel. I just don't see that. So, if we look at if we look at past recessions and we really analyze 1991, 2001, the 1980s, how did the housing market perform then? That's really what we need to be asking ourselves. So I think that, again, 2007, 2008, that's an anomaly. And it creates this awful bias against investment decisions if you're using that as your only basis. Now, I'm not saying like ignore 2007, 2008. I think that you need to understand what happened, but I wouldn't rely on that solely. I want to see long trends. I want to look at historical data and understand, well, what happened in each of these environments. Now, me personally, I hated history in school, but history depends on what history you're learning about. Some of it's more relevant to you than others. But for me, real estate, the real estate market history, the stock market history, economic history, this is really relevant to me. And I think it's really relevant to anyone who's trying to build wealth, who wants to leave a legacy for their family, who wants to build passive income. That history is really important. So drop me some comments, guys. Also, if you guys are new to the channel, please consider subscribing to the channel. You should see some links. You should see some videos up to my right and to my left. Definitely check out those videos. Very important videos. Do not miss out on those. But drop me some comments down below. Let me know what you guys think about what we discussed today. Share this video with a friend. Consider subscribing to the channel. I'm going to catch you guys on the next one. Y'all be safe.